Preliminary materiality, like I said, we determine it in planning, but then we can keep revising materiality right here, revised as appropriate throughout the audit. That could change as numbers change, as you find more risk. It could be any variety of factors. But you do determine preliminary materiality. You do have a number that you decide this is what it's going to be in the beginning. And it may never change. That may happen as well. What are some factors that are going to help you to determine this preliminary assessment? Well, the prior year financial statements. How did those numbers look? The size and the nature of the business, right? If we've got a massive business versus a business that only makes $100,000 a year, that's going to go into your calculation. And as I mentioned, like a lot of firms will have just big templates where you just plug in all these factors. You plug in their net asset balance, you plug in their revenues for the year, how many customers they have, whatever, however complex they want to make it. There are now algorithms, formulas, whatever you want to call them, that will generate what the materiality should look like. You want to plug in the prior year financial statements and current year financial results in comparison with each other. Macroeconomic factors, interest rates. Again, we're just going into what could be used. In reality, it quite varies. Anticipated risk levels, the client's business and industry. The firm might recognize certain industries as more risky. That could happen. The size, complexity, and organizational structure, the competitive environment, client's financial condition and liquidity, client's accounting practices and internal control, and then the auditor's familiarity with the client and its business. That's a big one. As you get more familiar with an entity, you understand more and you can apply your subjective experience more effectively. Establishing that materiality. Judgments about materiality are made taking into account the surrounding circumstances and involve both qualitative and quantitative factors. As we saw prior, we have things such as qualitative factors like our competitive industry, you've got economic factors, quantitative factors, what do the numbers look like? Materiality recognizes that some items are important for fair presentation of the financial statements and other matters are not. As we mentioned before, we want to take into account what the users of the financial statements want. What do they want? They want to make solid financial investing decisions. They want to know how well the company's doing. They want to know that these reports they're getting are accurate. An auditor's consideration of this is influenced by what he or she views would be important to the users of the financial statements. This is not really up for debate. It's pretty evident what the users of the financial statements want. If it's a bank, it probably they'll just tell you what they want to see, what they really want to be accurate. There we go. The level of materiality should be increased or decreased depending on the situation as more information may become available. As we mentioned, the audit will go on, the show will go on, and as it goes on, you will get more information with which to update and get more accurate. The auditor should determine a materiality level for the financial statements as a whole when establishing the overall audit strategy in the planning stage. We mentioned that. I'll drill that down here. Determining a materiality level for the financial statements taken as a whole helps guide the auditor's judgments in identifying and assessing the risks of material misstatements and in planning the nature, timing, and extent of further audit procedures. It's going to be super important. Everything's going to be based on materiality. If you're even going to test something, will be based on materiality. This materiality level does not, however, establish a threshold below which identified misstatements are always considered to be immaterial when evaluating those misstatements and their effect on the financial statements and the auditor's report thereon. I would never say thereon, but this is pulled directly from the AICPA's authoritative literature. But maybe I will. Expand my vocabulary a little bit. The circumstances related to some identified misstatements may cause the auditor to evaluate them as material, even if they are below the materiality level determined when establishing the overall audit strategy. We are going to adjust it as needed. Some things may be immaterial and then they become material. It can happen. We got to be ready for that. More establishing materiality. Let's talk about a benchmark. The determination of what is material to the users is a matter of professional judgment, taking into account, say it with me, qualitative and quantitative factors. The auditor often may apply a percentage to a chosen benchmark, as we saw that the firm wanted us to do in that example, as a step in determining materiality for the financial statements taken as a whole. When identifying an appropriate benchmark, the auditor may consider factors such as the elements of the financial statements. So, for example, these specific account balances in the financial statement measures defined in GAAP. So, we'll take those into account as well. We want to consider whether there are financial statement items on which, for the particular entity, users' attention tends to be focused. We mentioned this again. Anything that the users would want specifically. Want to take into account the nature of the entity, the industry, the size of the entity, nature of the ownership, and how it's financed. Is it highly levered? Do we just issue a lot of stock? How does that look? As we mentioned, we want to revise materiality as needed. We are going to have to assess, and it's just responsible, right? As you get more information, you can make better decisions. So it's only reasonable that you will reevaluate as you obtain more information. The auditor should revise materiality for the financial statements as a whole, and if applicable, the materiality levels or levels for the particular classes, transactions, account balances, disclosures. This is going to be our performance materiality again. In the event of becoming aware of information during the audit that would have caused the auditor to have determined a different amount initially. If you encounter something that would have skewed your thoughts in the beginning, just change it now. You just didn't know about it. So you're going to change it now. If the auditor concludes that a lower materiality than initially determined from the financial statements as a whole is appropriate, the auditor should determine whether it is necessary to revise performance materiality and whether the nature, timing, and extent of the further audit procedures remains appropriate. Take this into account. This is something you would do. Picture yourself. You are that senior, I just keep saying senior accountant, senior auditor, senior staff, because those were the individuals on my engagement who, working with materiality, obviously they had input from higher levels, but just painting a picture, making it, think whoever you want. Think of your favorite, your best friend on your engagement that you were working with, and they are going to be the ones determining materiality. The auditor would revise materiality in which of these instances? Well, all of these instances. If the client's business significantly changes in scale, and that makes sense. If we double in size, or even we increase in size by 10% because we acquire another company, we dispose of part of our company, that's going to significantly affect materiality. I mean, and this is not an exhaustive list. There will be many other instances in which materiality could be revised. When actual financial statement amounts differ from preliminary financial statement amounts that were originally used to determine materiality, again, just use your brain. If items and numbers have changed, your numbers should change as well. Significant changes in the client's industry, market, or the economy, macroeconomic factors, if we have worldwide global events, if we have recessions, anything like that, we should take those into account. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.